Good morning, everyone. Thank you for being here. My name is Mark Brender, co-chair of the Professional Development Committee of the Jewish Community Foundation of Montreal, alongside with Shelley Smith. J'ai le plaisir de vous souhaiter le bienvenue à l'édition 2022 de la Conférence de développement professionnel. One of the priorities of the JCF is to help professionals better advise their clients and find tax-effective methods for planning, while at the same time creating opportunities for smart philanthropy. We value our relationship with professionals like you and are very appreciative of our partnership. We're pleased to see this level of participation on Zoom and look forward to an in-person seminar next year. I hope the material presented will enrich your work and professional relationships and help you in your practice. I would also like to take a moment to recognize our Professional Advisory Committee for their help in crafting today's program. Nous souhaitons tout d'abord saluer nos conférenciers d'aujourd'hui. We have 6 speakers, actually 7, including myself, Carly Flam, William Zion Bernard, Rhonda Ruddick, Phil Nadler, Lindsay Lubov, and Howard Barish. It is now my pleasure to introduce our first speaker, Carly Flam. Carly is a partner in Robinson Shepard Shepherd's Family Law Group. Her practice focuses on divorce, separation, custody, child support, spousal support, and premarital consultations. Carly has developed a particular expertise in matters of contested custody, parental alienation, the denial of access rights, and the determination of support for the benefit of spouses and children in the presence of complex financial structures. Please join me in welcoming Carly.
Morning. Thanks very much, Mark. So I have been asked to present on a topic of increasing interest as the population demographically is aging, and we're seeing more complications with respect to matrimonial regime and estate planning. I'm going to try to demystify the differences between matrimonial regimes in Quebec and how these impact the liquidation of an estate, and also how estates should be planned for. The first point I'd like to make is that fortunately or unfortunately, all marriages come to an end via either separation, divorce, or death. And all spouses who are residing in Quebec, or principally residing in Quebec at the time of the dissolution of their marriage, will be subject to Quebec's very special rules governing the partition of assets and liabilities of the deceased spouse. And therefore, when adopting an estate plan, we have to take into consideration how these rules are going to intersect and impact the liquidation of the estate. The first set of rules that govern the partition of assets at the time of the dissolution of a marriage by death are going to be the family patrimony rules. In Quebec, we have a separate set of rules that don't exist elsewhere in Canada and are special to Quebec, called the family patrimony rules. And this is our primary regime for the partition of assets. And these rules have effect when a marriage ends via divorce. What that means is that regardless of what somebody puts in their will, these rules for the partition of assets that are set by law are going to apply to the estate. And if they are inconsistent with what is in the will, they are going to supersede the will and have to be applied first. Afterwards, the will of the testator will apply. The family patrimony is a regime that governs 5 categories of property owned by the spouses at the time of death. And these 5 categories of property are designed to include where most people in Quebec will hold most of their wealth. The private property, the family patrimony includes the family residences of the parties, the registered retirement savings of the parties, RRSPs and the like. It could be a RIF as well. The pension accumulated by the parties during the marriage, both government pension plans like the QPP and supplemental pension plans if that applies to the parties. And it will also include the contents of the residence, the furniture and furnishings of the family residences, and the cars, the vehicles owned by the parties. The 5 categories of property have a certain value that would have accumulated during the marriage, and that value is going to be partitionable between the spouses, regardless of whose name the property is in. So for instance, for a family residence, regardless of whether or not the house is in the name of a husband or a wife, at the moment of death, the value of that residence is going to be subject to an equal partition between the spouses. The partition of everything not falling into the family patrimony will be governed by the parties' matrimonial regime. There are in Quebec 2 possible matrimonial regimes. The partnership of bequests, which is governed by section 448 and following of the Civil Code of Quebec, and the regime of separation as to property, which is governed by sections 485 and following of the Civil Code of Quebec. The first thing that we should know as practitioners is how to determine what matrimonial regime the parties are in. The default regime in Quebec is partnership of bequests. So if you do nothing and you make no plan for the partition of your assets, and you are married in Quebec and divorcing, or your marriage is ending in Quebec by divorce, separation, or death, you will be governed by the regime of partnership of bequests as per section 432 of the code. The only way to opt out of the partnership of bequests is via a marriage contract signed before a Quebec notary, as per section 440 of the Civil Code of Quebec. So one of the ways that oftentimes parties come to me and I will ask, do you know what your matrimonial regime is? And the answer is, I'm not really sure. So then you can ask some follow-up questions. Prior to your marriage, did you sign a document adopting separation as to property? You would be surprised at the number of people that come to my office and say, well, I did sign something when I was getting married, but I'm not really sure what it was. So the follow-up question to that would be, did you go to a notary and sign this document in front of a notary? If the answer is yes, then the great likelihood is that the parties have a marriage contract. That is because in Quebec, unless you have signed a marriage contract by notarial act en minute, your marriage contract will be absolutely null and void. When can you sign a marriage contract adopting separation as to property? Generally speaking, it's done before the marriage. And that is because once you are married without a marriage contract, if one of the parties refuses to sign, basically the parties are in the default regime of partnership of bequests. The best and gold standard of when you should be negotiating and completing a marriage contract would be before marriage, when you're planning your life together and you're making financial decisions as a cohesive couple with common goals and common interests. There are times when parties would sign a marriage contract during the marriage. In that case, they would be moving from partnership of bequests to separation as to property. And oftentimes that is a more complex and difficult negotiation and more difficult to achieve. But it is done. So we should understand what partnership of bequests is as a legal regime, since it governs I would say the majority of people in Quebec, and certainly generationally, where I am noting, at least anecdotally, that fewer and fewer couples, young couples, are signing marriage contracts. I am noticing in my practice that it's becoming the dominant regime. So the partnership of bequests is composed of all property owned by the parties that does not fall into the family patrimony. So if it's not your family residence, if it's not your registered retirement savings, if it's not your pension, if it's not your furniture, if it's not your cars, then it is going to be governed by the partnership of bequest. So that would be shares in a company, savings, unregistered investments, income properties, cash, basically where most, I would say, wealthy people hold all of their wealth. And the basic rules of the partnership of bequest is that which was acquired by the parties during the marriage, regardless of whose name the property is in, is also going to be subject to an equalization of value between the spouses at the time of separation, divorce, or death. So this regime has effect at the time of death. And I should point out importantly that bequests include income as well, and the savings accumulated by the party's income during the marriage. There is carve-outs for what is the private property of the spouses. This is the property that will not be subject to an equalization of value at the time of the opening of the regime. And that would include property owned or possessed by either spouse at the time of the marriage. So what was accumulated by the parties prior to the marriage, what devolves to the spouses through gift or inheritance, and also the property that was acquired during the marriage in substitution of private property. We have to understand that with the regime of partnership of bequest, there is a presumption that the property or the assets of the parties is deemed bequest, is deemed subject to partition, as opposed to private property. So there's a legal presumption operating that unless you can prove that an asset is private property, that is to say that it was acquired prior to marriage or through gift or inheritance, that property is going to be subject to an equalization of value between the spouses at the end of the marriage. So what should you know about the partnership of bequest, the dominant regime in Quebec? That it's extremely complex and that it is extremely unpredictable in its application. So basically, the rules governing the partnership of bequest were not designed for complex financial structures for high net worth individuals with perhaps corporate structures that are in place. It was designed at a time, at a simpler time, when people's assets and liabilities were not enormous outside of the family patrimony. And the rules that are enacted in the code around the partnership of bequest are difficult to understand, and they're also difficult to apply, especially for a marriage of long duration. Because for each asset, we are being asked to look at the money that was used to acquire an asset, if it was private, if it was a bequest, and then do a complex calculation to determine what portion of the assets at the date of the end of the marriage are bequest and are private. And it requires a difficult work of proving the origins of each asset through tracing, through bank statements, through proof that is sometimes difficult to collect after a 20 or 30-year marriage. And also, the more complexity of the financial situation, the more that there's an interrelationship between different assets. And certainly if there's been a company and then a reorganization of shares and then a estate freeze and so on, these are complex transactions that make it difficult to suss out what is an bequest and what is private. And what we're seeing, and I'm certainly seeing in my practice, is the rise of accounting expertises requiring the services of a forensic accountant to actually calculate what is going to be subject to partition according to the rules of the partnership of bequest, and what is going to be deemed private property that is not subject to partition. So it's not even a calculation that an individual attorney can do very easily. Oftentimes, it requires an expensive and complex expertise process. And this represents, in the context of estate and succession, an additional burden for liquidators, because they are being called upon to do this work of calculating what is a spouse's entitlement as a consequence of the partnership of bequest. It's a regime that may affect the partition of the surviving spouse's assets as well, because it's an equalization that is required by the partnership of bequest. We have to look at what the surviving spouse's assets are made up of, and then look at what the estate's assets are made up of, determine what is an equest and subject to an equalization, and then determine the difference in value between the surviving spouse and the deceased spouse assets, and determine what the equalization payment should be to the more fortunate spouse. So there could be a great deal of, this creates a lot of tension with the surviving spouse, because it requires a high degree of collaboration and financial transparency. Separation as to property, which is a conventional regime, is where you sign a marriage contract indicating that all of the property that you acquire during the marriage in your own name will be yours at the end of the marriage, and all of the property of your spouse will be theirs at the end of the marriage. So it does not require this complex calculation of an equalization payment at the end of the marriage. It leads to a lot more certainty and a lot more clarity with respect to what the partition of the assets should be at the end of the marriage. So considerations for estate planning. When the spouse is the universal legatee, this doesn't present such a problem that there's the partnership of bequests or the family patrimony. The intention of the testator is for the spouse to retain the majority of the estate, and therefore the intention of the testator is for the spouse to receive a portion of the estate that's going to be more than what that spouse's entitlement would be according to the family patrimony partnership of bequest rules. So it's not usually a problem where the spouse is a universal legatee, but where the spouse is not a universal legatee, where they are either a particular legatee or not a legatee at all of a spouse's will, the partnership of bequest is going to create a lot of problems. Because what's going to happen is that the spouse is going to become a creditor of the estate, and their matrimonial claim to 50% of the value of the partnership of bequests, as well as the family patrimony, is going to create a debt that the estate owes and has to be paid before the other legacies can be paid out. And so when making an estate plan, you have to bear this in mind. So if there is no marriage contract, you have to take into consideration whether or not the rules of the partnership of bequests are going to be consistent with the legacies envisaged by the testator. Because if it's not dealt with in the will, it will become the responsibility of the liquidators. I'm coming to the end of my time, so I'm just going to come through this very quickly. It's very important when making a legacy towards a spouse that it includes a conditional renunciation to the partnership of bequests and other matrimonial claims, so that you're giving the surviving spouse a choice between whatever the particular legacy was and pursuing other matrimonial claims, but not both. Thank you very much for your time. As you can see, this is the complications of this regime make it so that it's important to work with a matrimonial lawyer at the same time as doing your estate plan. Thanks very much.
Okay, thank you, Carly, for your presentation. Our next speaker is William Dion Bernard, who also works at Robinson's office as a notary and partner of the Estates Wills and Trust Group. His practice focuses on asset protection, including all aspects of real estate law, trusts, wills, and protection mandates, marriage contracts, civil union, and cohabitation agreements, to name a few. Please join me in welcoming William to the PAC seminar. William.
Great. Thank you, Mark. Bonjour. Ma présentation ce matin, en fait, fait suite un peu à celle de Carly. Évidemment, là, je ne reprendrai pas tout ce dont elle a parlé, mais on va voir, en fait, dans les grandes lignes, comment tenter de prévenir des problématiques dans les règlements de succession en planifiant correctement. Et on va aussi voir certains enjeux qui pourraient survenir dans le cadre du règlement d'une succession. Donc, première chose que l'on doit faire dans un règlement de succession, c'est de prouver le décès. Ça va bien quand on a un corps qui est situé au Québec et qu'il y a quelqu'un qui est capable d'établir un acte de décès au directeur de l'État civil. Mais si ce n'est pas possible, après une période de 7 ans, on peut aller obtenir un jugement déclaratif de décès. Je trouvais intéressant de vous rappeler de l'affaire Carleton Université, où on avait retrouvé le défunt 6 ans après son décès. Pendant cette période de temps-là, c'était sa nièce qui avait géré ses biens. Puis sa nièce, en fait, ce qu'elle faisait, c'est qu'elle dépensait au fur et à mesure la pension que monsieur recevait de l'université. Et là, comme on a retrouvé son corps, là, il était parti en forêt, il souffrait d'Alzheimer, il était décédé. Ben, le jugement, il n'y a pas eu de jugement déclaratif de décès, c'était une preuve de décès qui a été constatée. Il y a eu un effet rétroactif. Donc, l'Université de Carleton a poursuivi la succession de monsieur pour récupérer les 6 années de pension qui avaient été payées injustement. Et, bon, évidemment, ils ont gagné. Mais si on avait réussi à obtenir finalement la preuve de décès après 7 ans, c'est à partir de ce moment-là que le décès avait été constaté et finalement, la nièce avait pu garder les années de pension reçues. Donc, c'est des cas particuliers. Évidemment, là, on a habituellement toujours une preuve de décès, mais si ce n'est pas disponible, on peut aller obtenir un jugement déclaratif de décès. Donc, la prochaine question, c'est est-ce qu'on est en présence d'une succession testamentaire? Souvent, les gens n'ont pas le réflexe, quand la personne est décédée à l'étranger, de faire une recherche auprès du barreau et de la chambre de notaire. Par contre, quand les gens laissent des biens au Québec, pourraient avoir fait un testament au Québec à ce moment-là. S'ils sont citoyens canadiens également, ils pourraient avoir fait un testament au Québec s'ils ont été domiciliés ici à un certain point. Donc, c'est toujours un bon réflexe de faire les recherches systématiquement dans tous les cas de succession, évidemment, auprès du barreau de la Chambre pour vérifier s'il n'y a pas un testament d'enregistrement. L'autre chose aussi qui est souvent oubliée, c'est la question du contrat de mariage. Donc, Carly nous en a parlé là, dans le cadre, évidemment, des unions civiles ou des mariages. Donc, les gens pourraient avoir fait des donations à cause de mort à l'intérieur de contrat de mariage. Donc, il ne pourrait avoir aucun testament enregistré auprès de la Chambre des notaires, mais il pourrait y avoir une donation à cause de mort enregistrée dans le registre des droits personnels et immobiliers. Donc, c'est toujours une bonne idée de faire la vérification, surtout qu'on peut faire des donations à cause de mort irrévocables par contrat de mariage. Donc, même s'il y a eu des testaments ultérieurement, ces donations-là vont toujours demeurer en vigueur. Donc, toujours un bon réflexe d'aller faire les vérifications dans le cadre du règlement de la succession. Ensuite, particularité pour les notaires, les avocats, souvent les clients nous demandent ça me prend la preuve de décès du directeur d'État civil, ça prend quand même beaucoup de temps à obtenir. Là. Donc, on peut accélérer le processus en tant que notaire avocat en faisant les demandes. Donc, on n'a pas besoin de montrer les évaluations médicales pour des mandats de d'études, on n'a pas besoin de montrer la preuve de décès officielle pour obtenir des certificats de recherche testamentaire. Donc, c'est quand même un avantage intéressant. Pour l'ère des PRM, je vous ai mis le lien. Donc, la consultation se fait toujours de la même façon, c'est avec le nom et date de naissance des parties pour les individus que l'on peut consulter l'ère des PRM. Ensuite, si vous avez une succession qui s'est ouverte au Québec, mais qu'il y a des biens qui ont été laissés à l'étranger, chaque juridiction, évidemment, a son propre droit des successions, et même au Canada, le droit des successions varie d'une juridiction à l'autre, donc chaque province va avoir son fonctionnement. Alors, c'est possible d'obtenir des lettres de vérification, soit auprès de la Cour supérieure ou d'un notaire. Donc, si par exemple, le défunt a laissé un immeuble en Ontario, fait un testament au Québec, et en Ontario, ils ont une procédure de probate. Donc, il y a un certain pourcentage de la valeur du bien qui va être imposé. Évidemment, on ne veut pas que l'ensemble de la succession se retrouve imposé en Ontario. Donc, on peut faire des lettres de vérification uniquement par rapport à ce bien-là. Donc, l'avocat en Ontario pourra continuer ses procédures de probate sur la base des lettres de vérification qui seront émises soit par le notaire ou la Cour supérieure. Ensuite, la question du legs particulier dans un testament. Je pense que toute personne qui rédige un testament devrait s'attarder de façon méticuleuse dans la rédaction du legs particulier parce que c'est habituellement celui qui cause le plus de préjudice ou de problématiques dans le cadre du règlement de la succession lorsqu'il n'est pas réfléchi. Donc, le principe en droit, c'est que, sauf exception, le légataire particulier n'assume aucune responsabilité quant aux dettes de la succession. Donc, les dettes de la succession, on peut penser bien évidemment aux frais, la liquidation, le comptable, l'avocat, le notaire, mais également les impôts. Donc, le décès est habituellement le moment dans notre vie où on va payer le plus d'impôts. Donc, si on lègue des biens à titre particulier qui ont une charge fiscale importante, sous-jacente, soit du gain capital ou, par exemple, un compte enregistré REER, bien, il y a une incidence fiscale importante de léguer ces biens-là. Donc, il faut d'abord l'identifier. Ensuite, il peut y avoir des biens qui ont des charges inhérentes à ces biens. Donc, par exemple, une hypothèque, si on lègue un immeuble, est-ce qu'on le lègue avec ou sans la charge hypothécaire? Donc, ça, il faut le préciser. Ensuite, si on lègue un bien, soit par exemple un droit d'usage, est-ce que c'est la succession qui va supporter les charges de cet immeuble-là? Est-ce qu'elle supporte les taxes foncières, l'électricité, les assurances? Donc, il y a des biens qui sont des fardeaux. Donc, comme par exemple un immeuble, habituellement, ça coûte de l'argent pour le détenir. Donc, qui va avoir cette responsabilité-là? Donc, prendre la peine de préciser dans le testament toutes ces questions-là et de ne pas tout simplement dire je lègue mon immeuble à mon frère, parce que à ce moment-là, bien, il va falloir aller dans la jurisprudence et déterminer, surtout quand les parties s'entendent pas, quelle est la répartition des charges de chacun. Il y a notamment la décision Clément contre de la Cour d'appel. En Cour supérieure, le notaire avait été tenu responsable de payer tous les impôts de la défunte parce que, selon la Cour, il n'aurait pas expliqué adéquatement à la défunte qu'en léguant ses immeubles à ses frères et sœurs, il y aurait un impôt important là, de près de 250 000 qui serait payé par la succession. Et là, comme le conjoint recevait la succession, il subissait un préjudice de ça et le juge de la Cour supérieure avait tenu le notaire responsable de payer l'impôt. Donc, un notaire qui a probablement eu 400 pour faire un testament se retrouvait avec une facture de 250 000 d'impôt. Heureusement, ça a été renversé en cours d'appel, mais c'était quand même un bon rappel qui, quand on fait des testaments qui sortent du cadre de « je lègue tout à ma conjointe sinon des enfants », ben, on doit s'attarder sur les conséquences de faire le testament. La question de la nullité, de la caducité, en fait, pourquoi je vous en parle? C'est parce que quand on rédige des legs particuliers, si un leg est considéré nul, ça n'aura pas le même effet que s'il est considéré comme étant caduc. Donc, la nullité, c'est, de façon générale, une cause qui fait en sorte que dès le moment où on a rédigé le leg, il n'était pas valide. Par exemple, le leg fait aux témoins, mais on a également le leg fait aux personnes qui travaillent dans le domaine de la santé. Donc, on a beaucoup de personnes âgées qui vivent dans des centres de longue durée. Donc, s'ils souhaitent faire des legs à des employés, ben, ils ne peuvent pas le faire, c'est interdit. Donc, à ce moment-là, c'est des legs qui sont nuls. Au niveau de la caducité, ben, on va penser, par exemple, à la personne qui est prédécédée. Ben, à ce moment-là, son leg devient caduc. La différence entre la caducité et la nullité, c'est que si on a légué, par exemple, un bien conjointement, je lègue ma maison à mon fils et à ma fille, si mon fils me prédécède, ma fille, par l'effet de la loi, va se retrouver 100% propriétaire de la maison. Par contre, si mon fils était témoin au testament, c'est uniquement 50% de la maison qui va aller à ma fille. Donc, encore une fois, quand on rédige le legs particulier, il faut vraiment prendre le temps de s'attarder à toutes ces questions-là. Il faut penser un peu plus loin, évidemment, que la situation qui est reflétée dans le testament, parce qu'il pourrait évidemment avoir des changements comme des décès, par exemple, qui peuvent survenir. Ensuite, on a les cas de révocation. Donc, tantôt, Carly nous a parlé de mariage qui prend fin par le décès, par le divorce. Donc, dans un testament, si les gens sont mariés, ben, automatiquement, les legs qui sont faits au conjoint, la désignation de liquidateur, vont être révoqués. Uniquement si c'est un divorce. En cas de séparation, séparation de corps ou séparation de fait, il n'y a pas de révocation automatique. Donc, c'est sûr que quand on rencontre des clients et qu'ils nous parlent de changements importants dans leur vie, comme une séparation, on devrait toujours prendre la peine de leur rappeler qu'ils devraient nécessairement changer leur testament. Il y a eu une décision récemment de la Cour supérieure où il y avait une révocation par divorce du legs au conjoint. Par contre, c'était dans le testament prévu qu'en cas de défaut de la conjointe, c'était ses frères et sœurs qui héritaient de la succession. Donc, le débat était, est-ce que au moment du décès de monsieur, est-ce que c'est les frères et sœurs de madame ou les frères et sœurs de monsieur qui héritaient de la succession? Et finalement, le juge a étendu l'aspect révocation du legs à madame également aux frères et sœurs de madame. Donc, encore une fois, même si le divorce évoque le testament, peut-être, en tout cas, je recommande fortement de refaire le testament de toute façon pour éviter des problématiques. Là, Ensuite, il y a la question d'option. Donc, évidemment, si vous avez une succession insolvable, c'est complètement un autre fonctionnement du règlement de succession qui s'applique. Il faut être encore d'autant plus méticuleux dans les étapes à suivre quand on est en présence d'une succession insolvable. Par contre, quand on fait des transactions sur une succession qui ne sont pas encore ouvertes, on va voir ça dans les conventions d'actionnaires, on peut voir ça dans des contrats de promesse d'achat. Des fois, les gens vont s'engager sur des droits qui n'existent pas. Donc, la personne n'est pas décédée, par exemple, maman n'est pas décédée, et les deux fils décident ensemble, bien, quand maman va mourir, c'est moi qui vais racheter la maison. C'est un PAC sur succession future, ça ne fonctionne pas. Donc, il faut faire attention à ces questions-là pour s'assurer finalement que le contrat soit valide. Ensuite, le droit d'option doit être exercé dans les 6 mois. À défaut d'exercer dans les 6 mois, il y a une acceptation tacite qui va, là, je ne sais pas que le texte est aussi petit, mais il y a une acceptation tacite dans les 6 mois et on ne peut pas revenir en arrière. Une fois qu'on a accepté la succession, bien, on doit la régler conformément à la loi. Il y a des cas de renonciation forcée, évidemment, quand on a été vraiment pas gentil avec le défunt, donc des causes d'indignité successorale. Je vous en ai donné plusieurs exemples dans la diapositive ici. Donc, ce qui est important quand on fait un règlement de succession, c'est l'inventaire et de garder une séparation entre le patrimoine qui appartenait au défunt et le patrimoine des héritiers. Si on fait de la confusion de biens ou si on ne fait pas l'inventaire de la succession, bien, on peut se retrouver responsable au-delà des biens qu'on reçoit de la succession. Donc, dans un règlement de succession, ce qu'on vise à faire, évidemment, c'est de ne pas porter la responsabilité des lettres au-delà de ce qu'on reçoit. Au niveau de la désignation du liquidateur, c'est important de prévoir qu'il va y avoir la pleine administration. La loi ne lui octroie que la simple administration, donc des gestes conservatoires. Il ne pourrait pas vendre sans consentement des héritiers, ce qui évidemment pose un problème important si on a des héritiers qui sont mineurs. Donc, il faut penser de lui octroyer la pleine administration. Évidemment, des fois, dans les successions intestables, on n'a pas de testament, donc c'est les héritiers entre eux qui vont désigner des liquidateurs s'ils le souhaitent. Et une façon d'éviter d'avoir tout le monde se présenter à la banque, chez le notaire, chez le comptable, bien, on peut donner des procurations au liquidateur pour agir en leur nom. L'autre chose aussi qui est importante, Carly nous en a parlé, c'est le cumul des droits successoriaux matrimoniaux. Donc, on va d'abord régler la question du mariage pour ensuite régler le cas de la succession. Donc, au niveau de la planification, on devrait prévoir des clauses de compensation. Je vous laisse ici un exercice. Le résultat risque de vous surprendre. Donc, peut-être à la fin, je peux donner la réponse dans le chat, mais dans un cas comme ça, j'aimerais savoir combien va avoir le fils, combien va avoir le monsieur suite au règlement de cette succession. La question de la survie de l'obligation alimentaire, Carly n'en a pas parlé. Par contre, dans un cas de règlement de succession, vous savez par exemple que les pays européens ont des réserves héréditaires. Donc, il y a la même chose au Québec via différentes facettes du mariage, mais également via l'obligation alimentaire. Donc, un conjoint marié, des enfants, on ne peut pas déshériter ça s'ils sont dépendants financièrement de nous. Donc, il faudrait à tout le moins, quand on fait le testament, prévoir des biens ou des legs suffisamment généreux pour les compenser adéquatement dans leurs droits alimentaires. Donc, les plafonds sont prévus dans la loi. Le conjoint a le droit à la moitié de ce qu'il aurait le droit en l'absence de testament. La même chose pour les enfants. Évidemment, on ne peut pas dépasser là, un certain seuil de la valeur de la succession. Donc, par exemple, quand on a un conjoint marié et des enfants, le conjoint marié a le droit au minimum 1/6 de la succession. Donc, c'est le maximum, ce n'est pas le minimum. Et il va avoir également pour les enfants, à ce moment-là, c'est la moitié du 2/3, donc dépendamment du nombre d'enfants, mais on va diviser le 2/3 en plusieurs parts. Donc, malheureusement, j'ai déjà dépassé mon temps. J'étais sûr que j'allais dépasser une présentation de 3 heures que j'essaie de faire en 15 minutes. Donc, beaucoup de sujets à aborder. Mais si je suis réinvité, mais je terminerai ma présentation dans un autre panel. Alors, je vous remercie et je vous souhaite une bonne journée.
Okay, thank you very much, William. I've been through your materials. I encourage our participants to go through the balance of your materials. So thank you very much for that. Our next speaker is Rhonda Rudick, who joins us from Davies. Rhonda has over 25 years of experience counseling clients on tax aspects of M&A, corporate reorgs, real estate transactions, with a strong emphasis on estate planning. Please join me in welcoming Rhonda to the PAC.
Great. Thanks, Mark, for the introduction and your comments on the presentation. Good morning, everyone. So I'm here to scare you with some examples of what can go wrong in estate planning with a couple of cases. So by way of overview, and I just want to make sure my slides, there we go. We're going to go through 4 cases in the 15 minutes or so that I have. The first case is Loria, and this is a valuation case. The next case is Glenmac regarding CDA planning. Then we have the case of Odette regarding gift planning. And lastly, the Robillard succession, which deals with pipeline planning. So in Loria, which is a valuation case, the facts were that in April of 2006, the taxpayers, who were executives at Gluskin Sheff, sold a portion of their shares to newly established family trusts at a price that was about 4.8% of the price at which those shares were sold under an IPO that closed in late May 2006, following the filing of a preliminary prospectus on April 18, 2006. And the pricing for the sale to the trust was determined by the Gluskin executives themselves. In other words, there was no independent valuation. The taxpayers instead applied a formula that was used in agreements under which they had purchased their shares from the founders a few years earlier. The CRA challenged the valuation determined by the taxpayers and reassessed them long after the normal reassessment period, on the basis that the value used to determine the capital gain on the transfer to the trust was a misrepresentation due to neglect or carelessness. The tax court accepted the opinion of the Crown's experts, which did provide for a marketability discount and for the risk of the IPO not occurring. But it did, and this resulted in a significantly higher valuation and gain on the sale to the trust. The court found that the CRA was justified in reassessing the taxpayers well beyond the reassessment period. And I'll read you the quote from the court. The appellants did not seek an independent valuation and cannot be said to have thoughtfully, deliberately, and carefully considered whether the proposed IPO would affect the share price. In fact, the appellants just seem to ignore it, when in my opinion, having regard to their skills in and knowledge of the securities industry from working as executives for a wealth management firm and the multiple other circumstances or red flags that went up, they were clearly aware of the impact of the IPO's value on their holdings. So basically, the takeaway from that case is the importance of getting an independent valuation, whether it's on a freeze or capital gains exemption planning or what have you. Very important to get an independent valuation. So the next case I'll discuss is GlenMac, and this regards CDA planning. So the facts were that GlenMac is a real estate holding company, and a trust was established by, we'll call him Jack, in 2009, and the trust held Class A preferred shares of GlenMac, and the trustees of the trust were Jack and his legal advisor. And in February 2011, Jack was diagnosed with a terminal illness, and around that time, Jack, his legal advisor, and his accountant from Deloitte discussed tax planning for GlenMac and the trust. So it was decided that GlenMac would redeem the shares and make an 83-2 election to have the resulting deemed dividend declared as a tax-free capital dividend. And the tax planning provided that the shares would be redeemed on May 2nd, 2011. And the resolution providing for the redemption of the shares was signed on April 26, 2011, with a May 2nd effective date. However, Jack died on May 1st. And since the shares were not yet redeemed on that date, his death led to unfavorable tax consequences. So the issue before the court was whether the court could rectify the resolution to provide that the shares were redeemed on April 26th, the date the resolution was signed, rather than on May 2nd, and correspondingly, if the CDA election form could also be rectified to be effective April 26th. So the GlenMac and the trust argued, firstly, they took the position that the May 2nd date was a mistake, and their intention was for the resolution to be effective as soon as possible and before Jack's death. And they later argued that their intention was that the resolution be effective on the date it was signed. They also claimed that the May 2nd date was inserted on the instructions of Deloitte to provide enough time to file the 83-2 election to avoid late filing penalties. The respondent opposed the rectification because it was clear that the party's intention was that the resolution would be effective as of May 2nd. And both parties referred to the Supreme Court case of Fairmont, a rectification case. And the judge refers to the following paragraph in Fairmont to explain the principle of rectification. So if by mistake a legal instrument does not accord with the true agreement it was intended to record because a term has been omitted, an unwanted term included, or a term incorrectly expresses the party's agreement, a court may exercise its equitable jurisdiction to rectify the instrument so as to make it accord with the party's true agreement. And the substance of a legal, well, I'll leave you with the rest of the quote, but essentially the judge concludes that the resolution cannot be rectified to be effective on April 26. He did not believe the applicants had an arrangement, the terms of which were definite and ascertainable, to redeem the shares as soon as possible and prior to Jack's death. And on the contrary, the judge agrees with the respondent that the conduct of the applicants in inserting the May 2nd date and not the date it was signed is indicative of an intention that the resolution was to be effective as of May 2nd. So I guess the takeaway from this case is that, while it's nice to avoid late filing penalties, I think it's, crucial to make sure that you get your planning done as soon as possible and maybe not leave that extra lead time in your documentation. The next case I'll talk about is Odette, and this shows where things can go wrong, where you have very good intentions to make a gift, and without proper planning and advice, things can go very wrong from a tax perspective. So in Odette, Mr. Odette owned all the shares of a company called Edmet Holdings, which was a private holding company, which were worth about $46 million at the time of death. And there was a large capital gain realized on death. And under his will, Mr. Odette left the residue of his estate to a foundation, including the shares of Edmet. So the timeline in this case, on November 17, 2012, Mr. Odette dies. On May 17, 2013 is the T1 terminal return filing due date. Then on July 2nd, 2013, there was a reorganization of the share capital. And on December 20, 2013, the estate gifted 139,000 shares of Edmet to the foundation. And then on December 23rd, 2013, Edmet purchases the shares for cancellation from the foundation for a promissory note of 17.7 million. The foundation issues a receipt for the note. And then on April 10th, June 6th, and August 6th, 2014, Edmet repays the note in 3 installments. So the issue is that the donation of the Edmet shares by the estate is deemed not to be a gift, except to the extent of the fair market value of any consideration other than a non-qualifying security of any person received by the foundation for the disposition by it of the Edmet shares. So the CRA assessed to reduce the charitable donation to nil on the basis that the promissory note issued on the redemption was a non-qualifying security. The estate argued that for these purposes, the consideration received by the foundation for the shares should be considered to be the cash payments, the subsequent cash payments of 17.7 million, rather than the promissory note, so that the donation would be deemed to be the 17.7 million and not nil. So the court rejected this submission and found that the act deemed there to be no gift. So I'll read you a quote. The cash payments were made approximately 8 months after the disposition occurred, not at the time of the disposition. The only consideration received at the time of the disposition was the promissory note. Parliament did not want to grant a tax credit where the donor is not impoverished and the charity is not enriched. A non-arm's length promissory note creates no real obligation to pay. It is important to show that the charity is actually enriched and the donor is in fact impoverished. A promissory note between non-arm's length parties is not convincing enough. So again, very important to get advice when you're making gifts. And the last case I will go through is the recent case of Robillard regarding post-mortem pipeline planning. So when the owner of a private company dies, taxes are payable on the deemed disposition of the owner's shares on death, and then again when funds are withdrawn from the company. So pipeline transactions seek to avoid this second level of tax. So a pipeline transaction is a method of avoiding double tax by selling the corporation to a new company, we'll call NewCo, in exchange, let's say, for a promissory note, and then having the corporation amalgamate with or wind up into NewCo, which repays the note. And the CRA's administrative position is that subsection 84.2, which can deem there to be a dividend, will not be applied if sufficient time passes, typically a year, before combining NewCo and the existing company, that during that time, the activities of the company continue, and thereafter the note is paid down over time, typically 4 quarters. So in Robillard, Mr. Robillard passed away June 18, 2012, owning all the shares of an investment company, we'll call it Holdco. And when he died, he was deemed to dispose of the shares at fair market value, triggering a capital gain. So the estate implemented pipeline planning by selling the shares of Holdco to NewCo in exchange for a promissory note. However, Holdco was then wound up into NewCo the next day. And 3 weeks later, NewCo paid down its note, and the estate distributed some of its proceeds to the beneficiaries the same year. So the minister claimed that 84.2 applied, to the indirect distribution of assets to the heirs of the estate, and that the estate had received dividends equivalent to about 1.6 million on the wind up of Holdco. And the minister argued that the estate's series of transactions were similar to those done in the Federal Court of Appeal case in McDonald. And the estate tried to distinguish McDonald and argued that Parliament did not intend for a distribution of surplus to an estate to be subject to double tax, resulting in a combined tax rate of over 70%. And the estate cited the loss carryback regime in section 164(6) as evidence of Parliament's intention to avoid double taxation. Now, the court in Robillard disagreed with many aspects of the Federal Court of Appeal's interpretation of 84.2 in McDonald, and believed that the phrase "at that time" in 84.2 should limit the application of the deemed dividend to persons who were shareholders immediately before the distribution. And I'll skip over the quote. But essentially, the court did find that technically 84.2, if you're reading it on its face, should not apply to deem there to be a dividend. The court also referred to 84.1 as proof of Parliament's intention to limit when a deemed dividend would occur. However, despite these comments, the court in Robillard felt it was bound by the precedent set in McDonald, and therefore the series of transactions did result in a deemed dividend under 84.2. So the conclusion here is to be mindful of the CRA guidelines and to follow them when you implement postmortem planning. And with that, I'll thank you very much.
Okay, great. Thank you, Rhonda, for that informative presentation. Look forward to the Federal Court of Appeal decision in Robillard. The McDonald case has always been a pet peeve of mine. It's wrongly decided, and this Federal Court of Appeal will reverse it, hopefully. So our next two presenters come to us from the JCF, Lindsay Lubov and Howard Barish. Lindsay has been a philanthropic advisor at the JCF since September 2021. She has a background in tax. She worked at Richter prior to joining the JCF. Howard is known to us all. He's an experienced practitioner specializing in tax for over 30 years, most recently as the senior tax partner at Collins Barrow, and currently acts as a consultant in philanthropic planning for the JCF. Please welcome them both. The floor is yours.
Thank you and good morning, everyone. I will start. Can you see me or am I out of the picture here? Well, nobody can talk to me.
You're not centered, Howard, but
how's that? That's better.
That's much better. There you go.
Okay. So basically, the main topic of our presentation is going to be on the donation of private company shares. However, I'm going to spend a minute now at the beginning and then a minute at the end on something else. But basically, just an update in terms of the last budget on April 7th, 2022. There had been discussion for a long time that the CRA wanted to increase the disbursement quota of charities. In other words, increase the amount that charities had to spend every year. After, I think, a few years of consultation and much discussion, it was finally decided that the disbursement quota will rise effective January 1st, 2023 from the 3.5% that is currently in place to 5%. This will probably be a bit onerous to some charities. Other charities won't be. For the JCF, for example, we have no problem meeting the 5%. We're way over it, but other charities and smaller ones may have trouble meeting the 5% and may have to look at their investments and their liquidity to make sure that they can make that disbursement quota on an ongoing basis. So that's all for this, just to bring everybody up to date on that and to bring it to your attention. Now, Lindsay will do the bulk of the presentation on the donation of private company shares. Go ahead, Lindsay.
Thank you, Howard. So statistics have shown that 70% of private and family business owners are planning to sell or pass on their business over the next few years. In our experience, it's actually happening right now. We've been seeing an increased number of transactions being special sales, like sales of businesses or real estate. So never mind over the next few years, it's happening now and it's exciting. For many years, the JCF has been helping put together plans for donations of private company shares. We like to call it the entrepreneur's dream. Why? These plans save enormous amounts of tax to the entrepreneur who has just realized a huge capital gain from a transaction. And we can structure it in a way where the entrepreneur does not need to immediately give up any money on this donation. They can actually have the opportunity to reinvest that money in their company or in real estate. We'll go over an example shortly to show how this would work. So when dealing with donations of private company shares, we're focusing on individuals or corporations who have realized a large capital gain. Because corporate value isn't always easily monetized, this is a great opportunity for registered charities to get into an untapped market for philanthropy. It's a win-win-win. It's a win for philanthropy and charities, a win for clients because of the significant tax savings they can realize from this, and a win for the advisors who are coming to their clients with new and innovative strategies. So we'll go over an example now. Let's say we have a corporation, which we'll call TaxCo, that realized a large taxable capital gain in the year. They sold a building and now they have a taxable capital gain of 6.67 million. Keep in mind, TaxCo could have been an individual as well. It doesn't necessarily need to be a corporation. So now TaxCo has this gain and they have big taxes to pay. Our objective is to set up a plan for a donation of private company shares in order to save taxes in TaxCo. Our first step is to figure out the value of the private company share donation we want TaxCo to make. Based on federal and provincial rules, TaxCo could only claim a donation receipt up to 75% of net income. So we'll assume there's no other income, just that they have this taxable capital gain of 6.67 million. So we would aim to have TaxCo make a donation of 75% of that amount, which would be $5 million. This type of donation would save TaxCo approximately $2.5 million of tax. So now that we've figured out the quantum of the donation TaxCo would like to make, we need to figure out which shares TaxCo is donating. It's preferable if TaxCo can donate shares of a company within the same corporate group, like a sister company or a subsidiary. We would rather do it this way from optics rather than setting up a new corporation for the sole purpose of making a donation. So in this example, TaxCo will donate private company shares of its sister company, which we'll call SisterCo. We would look to make sure that SisterCo has authorized capital for redeemable and retractable preferred shares with a market rate cumulative dividend. We'll assume 3% for the dividend. These are the attributes that give the shares value. You may need to amend the articles to create a new share capital with these attributes. So to summarize these first steps, TaxCo has a large capital gain and taxes that will have to be paid. It decides to subscribe to 5 million in preferred shares in its sister company. It actually goes ahead and cuts a check and makes the transfer of $5 million to SisterCo and gets back 5 million preferred shares in return. So now TaxCo comes to the JCF and says, we would like to make this preferred share gift to you. Here's a share certificate for 5 million preferred shares of SisterCo. We would like to gift that to you. So now the JCF will need to issue a donation receipt to TaxCo for its donation. Since it's not a cash gift, before we issue receipts, we would need a valuation of the shares. So we would have TaxCo's advisor write a valuation for these shares of SisterCo. The advisor would say something along the lines of, in my opinion, the shares gifted are worth $5 million. So now that the JCF has that valuation, we would issue a tax receipt to TaxCo for $5 million. So TaxCo claims the receipt on its corporate return and saves $2.5 million of tax. Meanwhile, SisterCo is still sitting with $5 million of cash, which it could invest, it could buy real estate, or even loan back to TaxCo. Given the shares owned by the JCF in SisterCo have a 3% dividend attached, we would have SisterCo pay an annual dividend of $150,000 to the JCF, which would go into the family's fund and can be granted to charities of their choice. And when SisterCo pays that dividend, assuming it's already paying tax on property income, it may be entitled to get a 38% dividend refund. So there's a reward there to SisterCo as well. So that's the deal. Look what we've accomplished. We put $2.5 million back in the entrepreneur's pocket, which is reinvested. The cost of doing this is $150,000 annually in donations, but many entrepreneurs will look at this and say, they're giving out 3%, but they're earning more over time with the government's money and with the $5 million that they're still holding. When you set this up, there should be some sort of plan to redeem the shares. The $5 million at some point will have to be outlaid to the family's fund at the JCF and be used towards charity. Sometimes it's redeemed right away, sometimes over 5 to 10 years, or sometimes it will be redeemed eventually when the donor passes away. So some people who plan to do this redemption at time of death may look at this and say, well, then why don't I buy a $5 million life insurance policy? So now maybe this person is paying $1 million in premiums over time, but at time of death, the insurance proceeds will come into the company tax-free and will be used to pay for the $5 million redemption. At the same time, when the $5 million of life insurance proceeds come in, you're also creating $5 million in SisterCo's capital dividend account. So now you have another $5 million that can be paid out tax-free on wind-up of the company or as a dividend. So what happens here is you've actually created wealth from this plan. You've taken $2.5 million in tax savings that otherwise would have gone to the government. You pay $1 million in insurance premiums. So just at that, you're up $1.5 million. Then at time of death, the $5 million share redemption is fully paid for by the $5 million in insurance proceeds. So this is why we call it the entrepreneur's dream. You're creating wealth, reinvesting proceeds from the transaction, saving significant amounts on taxes, and creating substantial philanthropy. You'll often hear of your clients' transactions coming before they happen. If you hear of a transaction happening in a taxation year and your client is interested in making a preferred share donation, you just need to make sure that the following is done before the year end in which the transaction happened. You would want to make sure that SisterCo has the authorized capital that we're looking for, so redeemable, retractable, cumulative preferred shares. You would want to make sure that the investment, in this case, which was $5 million, goes to SisterCo before year end so that there's a record of that. And we would want the donation to be made to the JCF before year end. This usually means signing a deed of gift at a notary. Howard will now briefly discuss other situations to keep in mind where a donor may benefit from doing a private company share gift.
That was very good, Lindsay. Thank you very much. Lindsay presented something which is, given the market today with large gains in real estate and private company shares, I think it's lots of opportunities for people there to really score a home run in terms of charitable giving. I will just take a minute to just remind everybody that there are also other situations where you may have preferred shares. You may have gotten preferred shares in an estate freeze or a crystallization, and so the shares would have a high ACB in the case of crystallization. And those are excellent opportunities also as a source of assets for which to make a donation. If you have an estate freeze where you may have had shares with a low ACB, by donating the shares, you can have capital gains treatment, whereas if you wait to redeem the shares or on death through even a 164.6, you'll end up paying tax at dividend rates, which today are substantially higher than capital gains rate. So just a reminder to look at those as other sources of donations. Crystallized shares has a high ACB, so you can make a donation without any tax and you still get the donation receipt. So that's my short comments on these other considerations. But once again, I'm sort of drawing you back to Lindsay's presentation, which is really there's excellent opportunities out there now to make substantial charitable giving at a relatively low cost. Thank you very much.
So thank you, both Lindsay and Howard, for your very informative summary of the federal budget proposals on the disbursement quota and the donation of private company shares. It truly is a win-win for the donor and the charities. So good morning, everyone. My name is Shelley Smith. I'm an indirect tax partner at BDO Canada and PAC co-chair with Mark. It's my pleasure and honor to be here with you all today. So every business welcomes referrals, and the Jewish Community Foundation is no different. Most of the foundation's growth has come from happy clients talking about the services of the JCF's offers and how tax-wise and easy it is to manage the philanthropy in this way. Many referrals come from professionals like you. And when this happens, we want to recognize them for their commitment to philanthropy. So introducing the concept of planned giving doesn't have to be daunting. It can be as simple as asking the following question. Have you thought about including philanthropy in your estate planning? And the professionals that we honor today have succeeded in doing just that. And many charities across all sectors are benefiting from that conversation. So this is our way of saying thank you virtually. So please accept our sincere gratitude to the following individuals: John Kaladian, Justin DeLille, Miles Lutner, Richard Schnerbach, Robert Raich, Barbara Novick, Brian Kreisman, Danny Ritter, David Lesser, and Jason Yudkovich. Again, from all of us here, thank you all once again. Our next two speakers, Mark Brender, along with Phil Nadler from Richter, are here to discuss the new rules affecting private corporations. So Mark, I guess he doesn't really need a formal introduction, but I'll do it nonetheless. He's a tax partner and leads Osler's tax group here in Montreal. His practice is broad-based and focuses on domestic and international tax planning, cross-border, and domestic mergers and acquisitions, corporate reorgs, tax dispute resolution. Phil Nadler, a tax partner at Richter and a former colleague of mine, provides tax consultation in diverse areas that include estate planning, corporate reorgs, mergers and acquisitions, divestitures, cross-border real estate, and investment planning. So on behalf of PAC, we welcome you both to this part of the session.
Okay, so I'm here, thanks Shelley and thanks Mark. I'm here to talk about the new proposed EFOL rules, which were announced in February, and the effect that it's going to have on, I think, a much broader base than what was anticipated when the rules initially came out. And I think it's important for everybody to understand in general what is happening so that we can properly advise our clients. So as a preface, in 2021, in the budget, there was an announcement that under the international tax measures section, that there was going to be a rule that would limit the deduction of interest and other financing charges in particular situations. It was introduced in the international tax measures section, and it referred to the fact that it was based on the base erosion and profit shifting proposals that have come out with the OECD. But in fact, when we looked at it a little closer, even in the 2021 budget, it appeared it was a little more broad than the way it was presented for so-called multinationals. The aim of these rules, which were not, there was no actual legislation given in 2021, was to deal with a perception of interest being paid out of Canada to low tax jurisdictions, the use of debt to finance non-taxable investments earned by Canadian taxpayers. For example, an investment in a foreign affiliate where the returns may come back in the form of exempt surplus, which wouldn't be subject to Canadian corporate tax. At the same time, the interest would be deductible. And a perception that Canada was bearing too much of the multinational group's overall debt. So in February 2022, just a few months ago, the legislation, the excessive interest and financing expense limitation rules, otherwise known as EIFEL, not like the tower, were announced, and they were effective for taxation years beginning on or after January 1st, 2023. There was a consultation period which was announced at the time of the February legislation, which is now over. The rules are extremely complex. And just as a preface, a few weeks ago, Finance Canada announced that they're still intending to proceed with the legislation. However, they are going to be making some changes given the comments that have come back from the community. So again, now these rules, by the way, are very, very broad, and we could probably spend hours going through them. There was, I think, 26 pages of legislation, a lot of it just being simple, not simple, but a lot of them being definitions, which are extremely complex, a lot of formulas. We're going to get to the sort of the basics of the rules so we can understand what is going to be happening starting next year. The basic rule, and it doesn't apply to an excluded entity, it also doesn't apply to individuals like natural persons. The basic rule is that no deduction of interest and financing fees in excess of a permissible ratio of a EBITDA, which is called adjusted taxable income, will be permitted based on certain ratios. So the ratio that's permissible in 2023 as an introduction is 40%, and after that the proposal is 30%. There is a possibility between a related group of corporations to transfer capacity, because one company, you may have more interest and their EBITDA number might be too low, and another company may have no debt but a higher EBITDA. So there's an ability to transfer capacity between related corporations. And there's also a group election where we file on a consolidated basis to do this on in fact a consolidated basis. We won't be talking about the group election because it's rather limited to consolidated groups, but we will touch on the transfer of capacity. There's also a carryback, which is not really a carryback, but we'll explain how that works. So basically, if I have excess capacity from prior years, I can use that currently. And if I have an excess that I have incurred this year that's denied, I can carry it forward and I can use my restricted amount within the next 20 years against my taxable income. There we go. Here's the basic calculation for the denial. And we'll go through some of the basic concepts. Is that we have the no deduction of interest and financing fees are allowed to the extent of this proportion, which is, as you can see, it starts with interest and financing expenses for the year. And then we deduct from that something called adjusted taxable income, which is the EBITDA concept I mentioned before, times the ratio of permissible expenses, which again is going to be 40% in the first year, 30% thereafter. We add interest and financing revenues to that reduction. In the event that we're lending on to other companies, there's a good benefit there. And as well, receive capacity for the year. Okay, that's again where another corporation in the group has transferred to us their capacity so we can use it and allow for some more room. And finally, the new term called absorb capacity, which again is if I had in the prior 3 years capacity that I hadn't used in my own company, I could carry that forward. Now, adjusted taxable income, again, very simply, is we start with our taxable income or our non-capital loss for the year, whether that's positive or negative, and we'll show that in our example. To that, we add our interest and financing fees incurred, and we also add our CCA deduction, and we deduct from that any interest and financing revenues we might have, which again is to take into account that we might be borrowing to lend to somebody else who is subject to the same rules. Again, the definition of adjusted taxable income is much more complex than what I'm saying, but I'm trying to get the general idea in front that there's a concept of really adding back certain expenses to get to an EBITDA number that will form the basis of seeing what kind of deduction we actually get for the year. Okay, so first example is we take a company that has taxable income of $100,000 after claiming all its normal expenses, including CCA and interest. There happens to be $100,000 of CCA claimed, interest expense of $200,000, So my adjusted taxable income is basically adding back those amounts, comes to $400,000. And then my proportion of denied interest, again, using this, it could be much more complex than this, but using this simple example, is I start with my $200,000 of interest expense, and I deduct from that my EBITDA times the permissible 40%, which we're using, again, the 2023 ratio. And I divide the whole thing by 200,000, which was, again, my interest expense. And that comes to 20%. So basically what comes out is I'm not allowed to deduct 20% of my interest expense. So on $200,000 at 20% is $40,000, and that's denied, and that could be carried forward. Or alternatively, it can be carried forward or perhaps, let's just leave it at that. It can be carried forward. And also my deductible interest then is $160,000. So we see that there's a partial deduction here of what we can actually take as our tax deduction. Now, let's look at the example where I actually have a loss before doing this, is I take my $100,000 loss, I again add back my CCA and my interest, which brings me now, instead of the $400,000 that I had before, it brings me to $200,000 of adjusted income, okay? And then when I apply my interest denial, and there's a slight typo here, it should show, instead of the 400K, it should say 200K. So I take my 200K minus 200,000, which is my adjusted taxable income, times again the same 40%. Okay, that's basically $80,000. So I take 200,000 minus $80,000 over 200,000 gives me a 60% ratio. So my interest denial here is I take 200,000 times 60% is 120. So that is denied and again could be carried forward. And my deductible interest is the $80,000. So we see, depending on what our income is before all the add backs, that may affect the permissible amount of being deducted, and it also might affect what is refused. Now we're going to just get into a very quick definition because it's going to affect, I think, the meat of what we're talking about is all the elections we can make and also who's excluded from the rules. So there's a concept of eligible group entities. One definition is an eligible group corporation, which is any corporation resident in Canada, which is related or affiliated with the taxpayer. Okay, affiliated, as we know, is generally something controlled, to keep it very simple, by the taxpayer or their spouse, versus related, which is much more broad. And then there's a concept of eligible group entity, which is any corporation or trust residence in Canada that is affiliated. So related is not carried here, it's just affiliated. Or a trust of which the taxpayer is a discretionary beneficiary, or if the taxpayer who's subject to the rules happens to be a trust, a discretionary beneficiary of the trust would be an eligible group entity, okay? Provided as a corporation or trust itself. Now, then we get to what's an excluded entity, because that's very important here. We see that these rules are very severe in the sense that they're going to be denying interest expense depending on how your interest and sits relative to your EBITDA for the year, and may have a very broad effect on many taxpayers. So one exclusion is if I have a CCPC, a Canadian controlled private corporation, with taxable capital of $15 million or less, okay? That's a basic one. Now, just for good news is apparently finance seems to be open to raising the $15 million in conjunction with the fact that they've recently raised the threshold for what's eligible for the small business deduction to $50 million. There seems to be some room there. Another excluded entity would be any entity where, as part of the group of eligible entities, the overall interest expense is less than $250,000 for the year. So again, that might apply to many of us, but not necessarily to everybody. Now, the main area that we would focus on for excluded entity is another test that meets 4 conditions. First is that the interest is paid to a non-tax indifferent investor. So let's assume that we're paying interest to the bank. That's number 1. And these 4 conditions have to be met. Second is that all or substantially all of the business is carried on in Canada by each eligible group entity. So that's an interesting test. So not only does this particular company carry on its business in Canada, it has to be that all the entities in my group will carry on their business in Canada, which may or may not be the case for all groups that we have. The third test, and this is, I think, a very significant one, is that there's no specified non-resident shareholder or specified non-resident beneficiary in the group of eligible entities. Okay, now a specified non-resident shareholder or non-resident beneficiary is a term that we see under the thin capitalization rules, which, by the way, still apply in these cases. And in simple terms, it's where we have 25% of votes or value in the particular company held together with any non-arm's length person. Now, we'll see that that's an interesting situation, because that actually may affect many situations beyond, I think, what finance was trying to look at, which was multinationals. And then second of all, as an interesting test, is there's no, within the eligible group of entities, there's no investment in any foreign affiliate, which is any foreign company where, in very simple terms, we own at least 10% within the related group, that we don't have any of those investments. So if those 4 tests aren't met, then an entity will not be considered under this test to be considered excluded from the rules. So, an interesting situation is we have, many, clients and taxpayers who put in family trusts owning a Canadian company. Well, if they have a non-resident who is a beneficiary of one of those trusts, and let's assume it's a discretionary family trust, then that individual, for those rules, would be deemed to own 100% of the shares owned by the trust, which would likely cause there to be a specified non-resident shareholder, which would mean the exclusion wouldn't apply. Another situation could simply be that we have one member of the family who owns more than 25%, who happens to not live in Canada. On the foreign affiliate situation, that's also interesting, because as we saw at the start, the rules are meant to go after situations where someone has borrowed to invest in a foreign affiliate, but we might just have a foreign affiliate that may have either no assets in it or nothing significant. For example, many Canadian active businesses might have a foreign affiliate that brings their goods across the border into the United States. They may not be investing, they certainly haven't borrowed to use those companies, but the way the rules are drafted is as soon as there's a foreign affiliate in the group, the exclusion is denied. Another rule to touch on very quickly is that there is an exclusion if there is interest charged between 2 corporations in the same eligible group. One can essentially make an election so that the rules will not apply to that interest. It does require an election, and under the rules as it stands right now, it will not apply to trusts or partnerships. But it is available. And again, trying to keep it very simple here given the time. Same idea, we're trying to keep it simple here. Transferred received capacity to taxable Canadian corps that are eligible group corporations that report in the same currency, where the taxation year of the transferor ends in the transferee's year, can make an election to transfer the excess capacity that one has to the other. And the idea is that it's meant to deal with, like I said earlier, a misalignment in the corporate group where one company may have a lot of debt and not necessarily enough EBITDA that year, and another company in the group may have no interest expense and enough. They may have no interest expense, but they may also they may actually have the EBITDA to support it, so they can share with each other. Oops, sorry. Final comments on these rules is one area where we see it having a major impact is going to be on real estate, where interest is a very big part, cash flow is a very big part. There's no grandfathering or entry into force for these rules other than the 40% to 30%. Essentially, assuming the rules are coming in and are not deferred, they will be effective, 6 or 7 months, depending on when your year end is. Now, the big question is, how do these rules dovetail with the original objective? The original objective was presented as being for multinationals to deal with, situations where cross-border payments were occurring. What we see here is that even though there's no interest going across the border in many situations, and admit that we may not have an exclusion from the rules, we see a different treatment of Canadian taxpayers relative to foreign investment, which will be an interesting discussion. For example, if I take the same example of myself setting up a company, putting in a certain amount of equity and then borrowing from the bank to buy a property, and then let's say a non-resident who puts in the same exact amount of equity, borrows from the same Canadian bank, and is not taking any interest expense out of the country, the income is subject to tax under the rules, not necessarily, a multinational as it were. We see that there's a different treatment for the wholly owned Canadian situation relative to the foreign owned business. So that's an interesting discussion. And I think in light of attracting investment to Canada will be an interesting question for us to consider. Now, moving on to other announcements that came out are the new FAPI measures, which were announced in the budget in April. We'll go through this quickly. Unfortunately, there's no legislation that came with this. It's really the idea, but the important part, it is effective right away. So we will talk about that. The major change to the rules, sorry, did I skip over? Okay, sorry. Mark is going to touch on the new substantive CCPC rules, where essentially, even if a company is not a Canadian controlled private corporation, the new rules will require that investment income in those entities, if they are controlled by a Canadian, will be taxed at higher investment income rates that CCPCs are subject to, even though it's not factually a CCPC. At the same time, they announced that they noticed that when we own a controlled foreign affiliate, that under the FAPI rules, there should be no FAPI inclusion if the foreign taxes paid in the foreign jurisdiction are at least 25% through the mechanism under 91 sub 4 to give a 4 times deduction for any taxes paid. For individuals, however, if they own the CFA, there's a different factor which requires a 52.63% foreign tax to avoid FAPI. So in looking at this, finance said they don't really think the deferral of having it corporately owned is correct. It's a very big change because this has always been a hallmark of foreign affiliate planning.
You'll need to wrap up pretty quickly.
Okay, I'll be very, very quick. Sorry, my slide is not. Yeah, so basically these rules are applicable for April 7th and following, for years commencing after April 7th, which is interesting because again, there was no legislation announced in the budget. And the interesting thing is while the factor is going to change, which you'll see the example in the slides, given that we won't have time to go over it, is that the concept is that because of the higher tax imposed at the level of the Canadian company, there will be a new inclusion to the capital dividend account to allow for the after-tax amount paid by the corporation to be extracted to the individual on a tax-free basis, similar to what we do with capital gains. Although, again, there's nothing there to show it. Very quickly, we just see in an example where $21,000 of taxes paid in the foreign jurisdiction. Under the old rules, we would have $8,000 of tax in Canada for a total of $29,000. Under the new rules, we would have $30,000 of tax in Canada for a total of $51,000. And anyways, just to end, basically the issue here is that there's no legislation that was really announced with the rules, even though they are effective in principle. If you had a year starting on May the 1st, the rules are now effective for you. There's no indication as to how the CDA will work. And as similar to the other rules, there's no entry into force to allow for any grandfathering of existing situations to our knowledge. And with that, I transfer over to Mark.
All right, thanks, Phil. With the time remaining, I'm going to try to cover as much as I can. So if we can get to my slides, that'd be great. The rules that Phil just went through are an accountant's dream with all the calculations required and a lawyer's nightmare. So I'm going to talk about some of the mandatory disclosure rules. I'm basically going to do a quick review of both the new federal mandatory disclosure rules and a refresher on the Quebec disclosure rules, because I fear that a lot of us tend not to think about them, but they are there and they have teeth. And then, time permitting, I'm going to talk about the impact of the substantive CCPC rules, which should be familiar to all of you. Now, a number of years ago, I spoke here and I talked about defensive tax planning, about how the landscape has changed. And so, to put it mildly, not only is it defensive tax planning for our clients, but we need to be mindful of this new paradigm, which is defensive tax planning for advisors. And by advisors, I don't just mean the lawyers and accountants in the room. It actually includes everybody. It includes the people who work at JCF. Sorry to instill some fear in you, Lindsay and Howard. It refers to the financial advisors. It refers to the valuators. It refers to the family office. It refers to everybody. That's how broad these rules are. It's somewhat scary. I'm not here to scare you. I'm just giving you what I think is a harsh dose of reality in the paradigm that we're living in. So as I said, these are the three topics. I'll launch right into it. We've got the mandatory disclosure rules, which we're building on the rules that were enacted earlier. This was part of a package that came out February of this year. And these rules really enhance and strengthen the disclosure requirements. There's really three categories of transactions that are covered. We have reportable transactions, notifiable transactions, and reportable uncertain tax treatments. So I'm not going to get into the UTP, the uncertain tax positions rules, in any great detail. Those apply to basically companies, corporations that prepare audited financial statements in accordance with IFRS and or domestic equivalents such as US GAAP. So we won't get into those. But on the reportable transactions and notifiable transactions, these are very, very, well, I won't say poorly drafted, just very broadly drafted, and in some cases poorly drafted, in the sense that they are extending to many situations that I'd like to think were not contemplated, but it seems to be hard in some instances to sort of pull ourselves out of the rules. So let's look at reportable transactions. So reportable transactions have two basic conditions to be triggered. One is you need to have an avoidance transaction, and the second is you need to have one of three hallmarks. Now, under the prior rules, you needed to have two of three hallmarks, and that usually took you out of any concern without even having to focus very much on avoidance transaction. But what they've done now is they've redefined avoidance transaction for purposes of these rules. And an avoidance transaction is not defined as we know it under GAR. An avoidance transaction is any transaction. One of the main purposes was to obtain a tax benefit. So I would submit to you that basically any tax planning whatsoever satisfies the one of the main purposes test. It'll be very, very difficult to establish that none of the purposes of your tax planning was to obtain a tax benefit. So by definition, I think you're going to satisfy the first condition invariably. So simple example, if I do an estate freeze, I have an avoidance transaction. The next question is, have I satisfied one of the three hallmarks? And the hallmarks, you would think that they are straightforward, but they're anything but. There's three hallmarks. You need to satisfy one of them. You have a hallmark for contingency fees. So that raises some questions as to, well, what does that mean exactly? If you're charging a fixed fee, if you're charging an hourly versus an hourly rate, if you charge a premium, how is contingency fee going to be interpreted? Not clear at all. Confidential protection, okay, that's what that's after, is usually trying to protect the advice that you were given. So when you send out your memo to your client, or your engagement letter perhaps, or your PowerPoint presentation, often when I'm reviewing PowerPoint presentations from accounting firms, for example, not to pick on the accountants, but very often there's disclaimers, and in the disclaimers is buried a reference to a confidentiality statement. So I think we need to be mindful of this standard language that we include in PowerPoints, in our engagement letters, etc., which, again, maybe this wasn't in the intent of the legislation, but the text is pretty clear, and I'm not going to rely on CRA auditors' good faith in not applying the rules in a way that would not sort of increase disclosure. So we should be mindful of that and take a good look at whether we have explicit confidential or sort of hidden confidential protection. And then thirdly is contractual protection. And that's a tough one. We'll get into that a little bit further. So, but all you need is one of each, one of the hallmarks to be satisfied. So the threshold for reporting is very low, I would submit to you. So now let's take a quick look at contractual protection. So there was an amendment to the legislation, and it's not exact. I said in the slide here that it's a helpful amendment, and I'm not so sure how helpful it is. I'd like to think it's helpful. It was brought in to address certain types of transactions, but it was far from clear. So I'll just, by way of example, one of the big issues coming from this is in an M&A transactions, you're doing a deal, you're selling your CCPC, and you're doing some pre-closing planning. Okay, so you have an avoidance transaction. Okay, and then in your documentation, your SPA, your share purchase agreement, or your asset purchase agreement, you have representations of warranties and indemnities with respect to tax matters. You may have a general tax indemnity, right? If you don't, then someone's dropped the ball, obviously. So you have that in just about every transaction. You might have a specific indemnity that relates to a pre-closing transaction, to a pre-closing reorganization, for example. And you may also have representations, for example, by the vendor as to the tax attributes of the target of the company that's being sold. So the company, you might, for example, they might represent that the company has, a certain amount of non-capital losses. The company has a certain amount of CCA. It has a certain amount of other tax attributes. And there are indemnities provided by the vendor with respect to, those representations. So one of the questions that's arisen is, well, is a general tax indemnity contractual protection? So I'll just state sort of my conclusion on this, but just to say it's my conclusion, but it doesn't mean it certainly doesn't mean it's right, because it's far from clear. But I think when you take into account what the purpose of these rules are and their scope for interpreting the words in a favorable way, I don't think a general tax indemnity is caught by these rules. And if we have time in a Q&A and someone wants an elaboration on why, then I'm happy to have that discussion. So then another issue that comes up, and this, which is also very common in the context of M&A transactions, which we're seeing in just about, not every transaction, but most transactions, we're seeing the use of tax representation and warranty insurance. And sometimes we'll see tax or issue specific insurance. which is very interesting if any of you have dealt with this. And it's very common and very effective, and it's something to be considered, and I think we'll see it more and more because it's a growing business for the insurers in the primary and the secondary market. I think we'll see this more and more. And it raises the question is, well, if you have tax insurance, right, is that a form of contractual protection? And so this amendment seems to address I'll call it the general tax representation and warranty insurance, but not clear. Does it apply to issue specific insurance? I don't think it does. So some submissions have been made by various organizations, including the Joint Committee of the CPA and Canadian Bar Association tax sections. So hopefully we'll get some clarification on this, but I think to sort of summarize this, I'd say that, third-party tax rep and warranty insurance probably covered, but unclear. Typical contractual indemnities for tax matters should be covered, not 100% clear, but should be covered. Issue-specific tax insurance, probably not covered. Here again, I'm talking about tax pools, or often you'll see a representation with respect to Part 3 tax for excessive CDA elections, etc. A specific indemnity for the loss of a tax benefit or the reduction of a tax benefit would clearly be caught. So you need to look at the documentation very, very carefully to determine if you have a contractual, if you have this contractual protection. The reporting must be done without going through the details, but basically it's got to be done pretty quickly, within 45 days of the transaction as a general matter. And the reporting is huge. Like, the detail that is required is significant. This is not something that will take an hour to complete. It is exhaustive. They're looking for details of every single transaction and disclosure, and this relates to the notifiable transactions, which I'll get to. Each person who is involved in some fashion in the transaction. So if you've got an estate plan and which involves a donation, and you've got some life insurance, I mean, everybody is involved, who's involved has this filing requirement, and as an advisor is potentially subject to penalties for failing to file or failing or making a deficient filing. And as we'll see, the failure to file results in a penalty for an advisor for the full amount of their fees. Okay, so this is pretty harsh, and these rules are probably more targeted, generally more targeted at advisors. And again, advisors is widely defined, promoters widely defined. That they're harsher in effect on the advisors than they are on the taxpayer who's getting the tax benefit, although it's quite penal to them as well. Now we'll move to the notifiables. So now notifiable transactions, sort of piggybacking on the reportable transactions, the structure of these rules are very similar to reportable, but these are specific transactions that have been identified by the CRA and sort of approved by finance as sample transactions where you must disclose. So in the reportable transactions, there's a judgment call to be made as to whether you have an avoidance transaction as redefined, one of the main purposes, or one of the hallmarks. But if you carried out a notifiable transaction or a transaction that's substantially similar to a notifiable transaction, then it is an obligatory disclosure to be made. And we have the same rules exist in Quebec, which I'll touch on briefly. Here's the samples here are 6 samples of transactions that were listed. For our purposes here, I'll focus you on number 1 and number 3, so manipulation of CCPC status, and number 3 is avoidance of deemed disposition of trust property, which can include a variety of different types of transactions, not just rollouts to Canadian corporations that are owned by non-resident beneficiaries, but to other transactions which are really designed to avoid the 21-year rule or to extend the 21-year rule by layering on new trusts on top of corporate beneficiaries, even where there's all Canadian resident beneficiaries involved. So here's an example of the manipulation of CCPC status. And basically what you have is a holding company that owns an operating company here called Subco. And if Holdco sells Subco as a CCPC, there's a 50.17% tax rate is triggered with refundable tax. But if Holdco ceases to be a CCPC before the sale, then at the time of the sale, it will not be subject to the refundable tax regime, and it'll be subject to the general rate of tax at a rate of 26.5 on the capital gain, which is an effective rate of 13.25, and still generates the CDA to the shareholders. So it's a pretty nice deferral if you're corporate deferral if you're going to leave the after-tax funds less the CDA in the company. And this type of planning was quite prevalent, has been quite prevalent in the last few years. So there's different types of ways to achieve that planning. And one example is, well, how do you give up CCPC status? Well, if your CCPC changes its charter to, for example, a non-treaty country such as BVI, the British Virgin Islands, which seems to be a pretty popular jurisdiction for this. It's been done with US LLCs as well. And you maintain, but simultaneously, so you change the governing law of the corporation, but simultaneously maintain central management and control in Canada. So it remains a Canadian resident corp. So you don't have departure tax on the Holdco, but it ceases to be a CCPC. An example of the avoidance of the deemed disposition of trust property we see here. You've got a trust which has might have started with Canadian resident beneficiaries, and some of the beneficiaries may have moved to the US, for example, and you want to, and in anticipation of the 21-year rule, but not necessarily so, the trust would if it distributed property to the non-resident beneficiaries, there would be a deemed disposition at fair market value by the trust, because you can't do a rollout of non-taxable Canadian property to a non-resident beneficiary. So what do? Non-resident beneficiary sets up a holding company, and the Holdco is appointed as a beneficiary under the trust pursuant to the terms of the trust deed. So these are the types of transactions. Here you see all of the information that's required. It's pretty heavy duty, and I'll leave that to you to read. The reportables we're going to skip over. Now the reassessment period consequence. So basically, here's the penalties. As I mentioned, there's two things. One is if you haven't filed the form, then the normal reassessment period, the 3-year rule, doesn't start to run until you file the form. There's penalties that apply, and as I mentioned, the penalties for the taxpayer. There's the there's the $500 per week, depending on the size of the taxpayer, plus 25% of the tax benefit, and for the promoter, it's 100% of the fees charged. Plus the it's the total of the fees charged plus the maximum penalty up to for late filing up to $100,000. So pretty harsh. There you have the definitions, which are there just to show you how incredibly broad these rules are, and that they extend to really anybody. And I would just make the point, for example, that I was thinking about last night. If you did an estate freeze and somehow you triggered one of the hallmarks, who would have to report if that happened? Well, I think everybody. You'd have the lawyers, the accountants, you'd have it's the firms, okay? You'd have the settlor of the trust. You'd have the trustees of the trust. It just goes on, and it might not be obvious that it goes beyond the actual active advisors, but it does include anybody who's involved in the any aspect of the transaction, any aspect of the transaction. You could have the valuator as well, the beneficiaries as well. So who reports? It's pretty broad. We'll skip over that. Now, all I want to say, so we have similar rules in Quebec. Okay, I have a few slides here. I'm not going to go through them. The rules are, for all intents and purposes, very similar to the federal rules. The trigger, though, is for the reportable it's a higher threshold, but on the mandatory disclosure regime, very similar to the federal rules. It includes different transactions. Then it includes, there's some overlap. It does pick up on the 1072 planning, the distributions to avoid the 21-year rule, but it also extends to capital gains splitting, multiplying the capital gain exemption. They don't like that one, and they want disclosure. They want disclosure of them. They're looking at situations where the funds are landing in, not in the children's, not in the beneficiaries' bank accounts, or that they find their way indirectly into the parents' or the freesor's bank account, for example, or that the funds are being used for inappropriate purposes, not for the children's purposes, for the children's benefit. So pretty harsh. And then I guess that the only point that I'd want to make here is that, and this occurred to me last night as well, which is if you are caught by these rules, the Quebec rules and the federal rules, and you're an advisor, right? You are at risk for 200% of your fees, because it's 100% penalty federally and 100% penalty in Quebec. And if someone sees that differently, I'd really like to know, because it just really is extremely harsh, as you can see. I am going to spend 2 more minutes and then close it out. I'm going to go to the substantive CCPCs. I talked about what the planning is all about. The intentionally triggering non-CCPC status. There's a couple of cases that are winding their way through the courts right now, so we'll have some guidance from the courts. But given the time and expense in pursuing these cases, finance decided that they would just, try to put the kibosh on them by requiring mandatory disclosure. Now, remember, these rules, both the Quebec and the federal rules, they're not saying that GAR applies. They're not saying that the planning doesn't work. They want to know about these transactions. They are interested in these transactions, and they want to see what's going on in the marketplace so that they can evaluate and have a pecking order, if you will, for who they're going to audit. So if you've done one of these transactions and you file the form, you could be sure that you're going to rise, to the top of the list or somewhere close to the top of the list. So this elaborates on the manner in which the CCPC status is lost when a 111.4E designation is made by the company to trigger a deemed disposition, to trigger the gains, and to stream out the CDA and pay the lower tax rate. Substantive CCPCs, basically the rule applies in such a way so as to cause all those companies, so the BVI company that is resident in Canada but doesn't meet the technical definition of CCPC, will be considered a substantive CCPC and therefore subject to the refundable tax regime if the BVI company is controlled directly or indirectly in any manner, whatever, by Canadian resident individuals. So you go all the way up the chain, and if you see Canadians at the top, doesn't matter what you have down in your chain, the company will be treated for this purpose and for that purpose only as a CCPC, thereby negating the tax benefits of that planning. So those rules effectively put an end to some of the more aggressive CCPC planning or non-CCPC planning. And it's we don't have all of the rules, but the basic definitions are out. The basic definition is out there, and it's pretty, it's pretty tough to get around. Now, what does this mean for these types of transactions? Well, you can still do the 111.4E planning with if, for example, if the target has non-capital losses, you still step up trigger gains up to the amount of your non-capital losses. Anything in excess, though, will not be subject to the 26.5% rate, even if you're technically not a CCPC. Because you're a substantive CCPC, the 50.17 would apply on the excess. So you can still do this planning, at least with respect to the extent that you have non-capital losses. And so with that, I'm going to close out there. We're out of time, and I will turn it over to my colleague.
Hi, thanks, Mark. Hi, everybody. I'm Kathy Asiag. I'm the Executive Director of the Jewish Community Foundation. Tout d'abord, je voudrais dire un grand merci à tous nos conférenciers et un grand merci aussi à nos coprésidents Mark et Shelley. It's been a great PAC conference, and I just want to share a few things before we move to our question period. First of all, it's been our experience that a lot of the growth in philanthropy, whether it's at the JCF or elsewhere, is coming from referrals from professionals like you, people who take the time to talk to their clients about thoughtful planning and smart philanthropy tools. And you heard Lindsay share one of those tools, which is gifts of private company shares, which Lindsay explained very clearly and very professionally. There are other tools, gifts of appreciated marketable securities, gifts of insurance policies that sometimes have a lot of value, flow-through donations, many tools that we have that we've coined smart philanthropy tools. So we encourage you to continue to talk to your clients as trusted advisors, and we're always available to you and your clients should there be an opportunity to create more philanthropy through smart planning. In addition to this annual PAC seminar, the JCF is committed to doing more for professionals, and we're launching the Center for Philanthropic Learning, where we will bring great speakers, interesting topics, so that we're engaging with you more often throughout the year. So stay tuned for more offerings. We're always available as well, the whole professional team, to come to you at your firm, your office, for breakfast meetings or lunches, to talk about these wonderful tools that you can offer your clients and build strong relationships as a result with your clients. So again, thank you to all our participants, and we're now going to open it up for questions. I know there was one question that was asked early on in the chat, and it's directed to Carly. It was a question from Nancy saying, on a second marriage, if the home was acquired pre-marriage, is it excluded from the family patrimony? So we'll start it off with that, and then we'll move to any other questions people might have. Just type it in the chat box.
Thank you, Kathy. The criteria that are going to be determinant as to whether or not that house falls into the family patrimony is not necessarily the issue of it being a second marriage, but it's going to be when the house was acquired. So if a house was fully acquired by one spouse prior to marriage and fully paid off, that means no debt, no mortgage, then that house is going to be exempt from partition. That would be the criteria.
Thank you, Carly. Are there other questions that any of our participants would like to ask? You can just put it in the chat, type it in the chat.
I think we either scared them or it was so clear that there's no questions.
Yeah. So you may be right. I mean, there's so much information there. Please rest assured that we will be publishing the presentation, so you will have access to them on the website. Shirley will be sending them shortly. So with that, maybe Mark, you want to say a word of thank you?
Yes, so thanks everyone. This was really enjoyable given the circumstances. I look forward next year to all of us meeting in person in our usual spot, and we'll no doubt have some wonderful topics for you. And I encourage anyone attending, if you do have topics that you would like us to consider, please send them along to us, any one of us, and we'll take that into consideration when we're putting together the agenda for next year. So I see a question has come in. So it's back to you, Carly. What if the house is not fully paid for?
If the house is, the portion of the house that was paid off during the marriage is going to be subject to partition, and the portion of the house that was paid off prior to marriage is going to be considered excluded from partition.
Okay.
Thank you.
All right, so with that, I think we're done. So thank you very much. Thank you to all of our presenters. Great job. Appreciate the efforts put in. Sorry that you didn't get to cover all of your slides, but the materials are available. I see a question has come in, re-notification and M&A transactions, some examples. Well, I mean, I think so the question here is, can you give an example of when you would be required to give notification or have a mandatory, a reportable transaction in an M&A context? Well, I think, or a notifiable transaction. So I think the low-hanging fruit, that's the low-hanging fruit example there is, if you are doing a transaction, you've got a sale of shares of your opco and you're selling it to a US acquirer, okay? You're going to do a two-step closing. So you're going to have a sign and then close. Between the consequence of signing the agreement to sell at a later date, the target ceases to be a CCPC, okay? And so any planning that would be done in that period, which would involve, for example, very common planning would be to trigger internal gains and strip out CDA and have the taxable portion of the gain in the target subject to the non-CCPC rate of tax, 26.5 versus 50.17. And so if you were to do that example, the company would qualify as a substantive CCPC, okay? And if you did that planning, or could qualify as a substantive CCPC, if you did that planning, you'd have a requirement, a notifiable transaction, because you have a right, which is the right under the purchase and sale agreement of the non-resident who now has acquired control, who has caused the company to cease to be a CCPC, and you would then have a filing requirement. I think a well-advised client would not take the position that it's a CCPC, would concede that it's substantive CCPC, and would not do the planning. But if you chose to do the planning, then you'd be required. It would be a notifiable transaction. So I think that's I think one good example. And there's another question asking about exclusions. I'm not sure exactly what the question is getting at there, so maybe I could take that offline. But like I said, if you fall into the category of those listed transactions, you must disclose. And if you're concerned about the tax planning that you're doing, you need to take a good look and ensure that you haven't satisfied one of the hallmarks. So this goes to the point on the contractual protection, for example. So, you know, a vendor, right, can become a promoter for purposes of these rules if the vendor is making a representation to the purchaser in a way that preserves a tax benefit that the purchaser is trying to obtain in the transaction. So if there's an internal reorganization pre-closing that's being done at the purchaser's request, for example, because they want to step up the cost basis of goodwill, for example, and the vendor gives a representation that supports that planning, then the vendor becomes a promoter under these rules, and a disclosure would be triggered for all parties involved in the transaction. As an example, further example.
Thank you, Mark.
Okay, no more questions. So
Have
thank
a
you
great
again,
day,
everybody.
everyone.
Bye-bye.
Bye-bye.